Chapter 13, Trading Strategies. Section 3, Mean Reversion. Mean reversion is the idea that when price gets unusually far from its recent average, it often tends to drift back toward it. Think of the average as a reference point, not a magnet that always works. And remember, this tendency is usually strongest when the market is calm and moving sideways. What matters most is the market environment. Mean reversion tends to work best when price is rotating inside a range with support and resistance holding, and it becomes much less reliable when a strong trend is pushing in one direction because price can stay stretched longer than expected. Indicators can help you define what stretched actually means. Traders often use RSI readings above 70 or below 30, distance from a moving average, or standard deviation bands to spot extremes, but those tools only identify the setup. They do not prove that price is ready to reverse. A simple process keeps the idea practical. Start by choosing a mean, such as a 20-period moving average. Measure how far price has moved from it, wait for a genuine extreme, and then make sure the market is still behaving like a range before you plan a trade. An extreme reading by itself is not the entry. It helps to wait for price to show some actual reversal behavior, like a bullish rejection candle for a long setup or a bearish rejection candle for a short, instead of stepping in while price is still accelerating against you. Before entering, define the trade from start to finish. That means taking the entry after confirmation appears, placing the stop beyond the recent swing with a little volatility buffer if needed, and sizing the position so one trade cannot do outsized damage to your account. The goal is usually a return to normal, not catching the start of a huge new trend. Many traders take some profit as price gets back to the moving average, move the stop to break even, and consider exiting more as momentum settles toward the middle, often around an RSI reading near 50. In this Euro-USD example, the setup comes together in a very typical way. Price is holding inside a range, RSI drops to an oversold reading near support, a hammer signals rejection of lower prices, and that gives a more structured reason to enter long with the expectation of a move back toward the average. Most failed mean reversion trades come from using the idea in the wrong conditions or managing it poorly. Common problems include entering too early, trying to fade a strong trend, placing stops so tight that normal noise takes you out, or staying in after the market breaks out of the range. A great way to build skill is to review recent charts and practice identifying valid setups for yourself. Use a 1-hour chart, add a 20 periods SMA, RSI, and ATR, then find one overbought and one oversold example in a ranging market and record the entry, stop, target, and result so you can see what actually worked.